What's up, guys? This is Manoj Oprani. I welcome you all on behalf of the Edupedia world. So, guys, I'm sure you are having a great day today, and certainly you are enjoying your day to the fullest. So, guys, by now we have already covered 4 of the video presentations relating to the topic of equity analysis and valuation. Head start. Moving averages. Moving averages are actually one of the most popular and easy to use tools which are available to any of the technical analysts. They smooth the data series and make it easier to spot trends. They form building blocks for many other technical indicators and overlays. Just like Bollinger Bands and charts, they act as a building blocks for all those many other major technical indicators and overlays. Next, moving averages are smooth interpretation of price trends. So guys, it's actually quoted very right. Technical analysts usually use them on a day-to-day basis for trading distortions and interpreting the noise which is available and that interferes with the identifying price trends, and consecutively they help out in spotting buy and sell signals in the market. So that's how they do. Moving averages are actually useful technical tool, as it provides investors with a buy and a sell signal. And first of all, guys, always remember, the longer the time period, the greater is the significance of a trend once a signal occurs. A short-term moving average, say 5 days, can yield a lot of signals. Many of them might prove false, while a longer term, let's say 200 days, 300 days, that provides fewer or more reliable kind of signals, but may miss many of the parts of the trend. So each and everything has its pros as well as its cons. So we'll have to look for each one of them over and again. Okay. And apart from this, whenever a kind of securities price crosses its moving average from below, it's basically an indication that of the beginning of an upward trend. Always remember that, guys. And when it crosses from above, then it's a signal of a downtrend. So if we could use the crossing of price bar and the moving average, one could easily see numerous false signals because of greater volatility in its pricing. Using a short-term moving average in place of security price in conjunction with longer-term average will surely produce clear trading signals, because there will be fewer, more definitive crossings of the two lines. So that's how it actually works. Undoubtedly, there are numerous kind of uses for moving averages, but certainly if I have to conclude it in a simpler way, it has majorly three basic uses which stands out. One, it helps you in trend identification. So how, in what way, in what manner trend is going on, whether it's an upward trend, whether it's a downward trend. Because let's suppose, same example for a fast bowler. If he is consistently bowling with a upper speed, okay, 140, 141, 142, 143, 144, 145. So what do you expect out of it? Okay, this bowler is like increasing its speed with each and every ball he delivers. So that's an upward trend, right? And if in case he starts out with 145 and inches over by like 140, so you'll be simply saying, okay, he is basically going with a downward trend as far as this speed of the ball is concerned. So the basic thing of moving averages, it helps you in identifying the trend and the confirmation for it. So trend is easily identified with that, and confirmation can be easily done for that. Apart from this, the second kind of basic use is it provides support and resistance level in identification. So you can easily think about the kind of support and the resistance level. I did told you about this particular support and resistance in my last video presentation. If in case you have missed it out, definitely go for it. You'll be able to know it very well, how support is basically done and how you can be aware of the idea what a resistance is with the help of that video presentation. And the third basic use for it would be it helps you in setting the trading systems, which is absolutely very much of imperative nature nowadays, since technologies are actually concerned, and certainly world is moving at a very faster pace. It has to be ensured that you are able to set up your own kind of trading system as well, wherein you'll be able to extract the best kind of returns as far as the different market is concerned. So that's how it moves on. So these are the basic uses of various moving averages. So now let's discuss about the basic 5 moving averages which I just narrated to you. So let's move to our next slide, and that will be about the types of moving averages. So these are the basic 5 moving averages. One is simple, second is exponential, third one comes in variable, next comes triangular, and the last one is weighted. Weighted is basically used up in simple, exponential, variable, triangular, in each one of them. So we don't have anything of criteria which is called as like specifically going for a weighted average. So weighted is being used in each and every kind of stuff. So weighted is primarily going to be involved in each one of them. So that's how it's going to be done. First of all, we'll be taking up simple, then we'll be heading towards exponential, finally towards variable, and I'll be concluding my video with triangular. So let's head start to simple one first. So what does simple moving average means? So guys, simple moving average basically means the one which gives equal weight to each day in a period and is calculated by dividing the sum of several days of closing prices by the number of days. So that's a good thing about simple moving average. It's give the weights, equal kind of weights to each and every kind of closing price for various several days. So it will be, each one of day will be like multiplied by 1. So that's the thing about it. So if you'll be like talking about the concept crux with it, so I'll simply say a buy situation or a bullish signal is generated when actual prices rise through moving averages on high volume, whereas a sell or a bearish signal is generated when actual prices decline through the moving average of high volume. So it has to be taken care of. That's the basic concept as far as this moving averages are concerned. So let's discuss about one of the example of simple moving average, and hence thereby you'll be able to get an extreme kind of clear idea as to how it moves on. So that's an example for one of the stock trade security which is available in the market. So if we'll be discussing about the 10-day prices of it. So on day 1 the price is 188.05. On day 2 the price moved up with 192.35. Third day it went down with 191.35. Fourth day it again declined with 188.05. And finally on the 5th day it gave you a rise in the price with 192.40. So if I have to like sum it up in one simple manner, what I'll say as the 5-day moving average, I'll simply do one thing. I'll multiply the first day's closing price, that is 188.05 into by 1. The next day's closing price, that is 192.35 by 1. Again, the next day's, that is 191.35 into 1. So thereby I'll get one figure. Okay, I'll be simply adding 188.05, 192.35, 191.35, 188.05, and finally 192.40. I'll be adding all these 5 days prices, and I'll be like simply dividing it by 5, wherein I'll be able to get the 5-day moving average as 190.44 for the first 5 days. That's how simple moving average is actually calculated. And in case of, if I'll have to like ask for the 6th day about the 5-day moving average, what I'll do, I'll just skip out 188.05, that is for the first day. I'll just skip out that one and I'll make 190.45 into my calculation. So that will be extracted as 192.35. If you can see over here, 192.35, 191.35, 180.05, 192.40 and 190.45. And I'll be like adding all these 5 and I'll be dividing it simply by 5. Wherein I'll be able to get this as 5-day moving average. And this is how it goes on. And finally I'll be able to get on the similar, by applying the similar kind of formula, I can simply get the simple moving average of the 10th day as 174.82. And that's how it works, guys. This was the most simplest kind of moving average that you are studying from the class, like almost 5th class, 6th class. So I don't have to like tell you any more thing about the same. You'll be like able to do it on your own in a very good manner. So let's move to the next one, which is the most important one, as exponential moving average. So you must be thinking about what does exponential average basically means. So without a delay, I'll just narrate you with one such thing. So guys, exponential moving average basically differs from a simple moving average both by calculation method and in a way that prices are weighted. So here's the catch, and that is the EMA, that is exponential moving average, is effectively a weighted moving average. So guys, that's a kind of difference between the two. Simple moving average, we used to apply equal weights for each kind of closing price for several days. But in case of exponential moving average, that is not on the basis of simple weights, like equal weights. That is on the basis of weighted average method. So we'll be applying weights according to the maximum kind of weights to the one which is the nearest closing price. In EMA, the recent day's prices are given more weight than older prices. The theory behind this is that more recent prices are considered to be more important than older prices. So obviously guys, if I'll ask you one thing about taxation, okay, so nowadays if taxation is like 30% flat for companies, okay, so earlier it used to be like, let's suppose 10%, 15 years or 20 years down the line. So if tomorrow I'll have to calculate or get a kind of figure for my next year, what is the most likely taxation structure would be. So what will I do? I'll simply give the maximum amount of weights to the most recent one, that is 30, because that's the most likely kind of chance wherein I'll be able to have a taxation regime and taxation structure as almost equivalent to 30% only in next year as well. I'll be having a taxation structure of like 10%, which was available 20 years back next year as well. So that's not going to happen in any way. So that in that case, I'll be putting more of the maximum weights with my closing taxation structure, taxation rate, which is available currently. So with the same kind of theory that is being applied to securities as far as exponential moving average is concerned. This theory basically allows you to go for more recent prices are basically considered to be more important than older prices in this case. Calculation of the EMA is a little more complex than the simple moving average just because of these weights. So by how we'll be able to know about exponential moving average, let's go for it. So in order to calculate a new EMA, all we need are the EMA for the previous day and today's closing price. So that's how we can easily compute and calculate the new exponential moving average on the basis of exponential moving average of previous day and today's closing price. Now you'll be thinking about how that can be done. Surely that can be done, and we'll be discussing about the same in my next slide, and that will be calculation of exponential moving average. So this is the basic formula for calculation of today's exponential moving average, and that will be current day's closing price into exponent plus previous day's exponential moving average into 1 minus exponent. So now you guys must be pondering about the fact, what does this exponent actually mean? Sir, kindly tell us what does exponent mean, so that we can easily solve this question, right? Perfect guys, I know that you'll be actually having this doubt in your mind, so let's clear it off. What does exponent mean first? So guys, initially for any kind of EMA, exponent needs to be calculated. To start with, just go with the flow. That is, take the number of days EMA that you want to calculate and simply add 1 to the number of days that you are considering. For example, if in case you are going for a 30-day moving average, then what you will have to do? You'll simply add 1 to get 31 as part of the calculation. Okay, I can simply call this as days plus 1. We find out the exponent by simply taking the number 2, and dividing it by number of days plus 1. For example, the exponent for a 10-day moving average would be, what would that be? It would be simply 2 divided by 10 plus 1. Okay, 2 divided by number of days plus 1. So for example, in case of exponent for 10-day moving average, that would be 2 divided by 11, and it will come out to 0.1818. So if in case you are calculating the exponent for like 20 days moving average, what you'll have to do guys? Simple, 2 divided by 21, and that will come to around like 0.09 something. And in case you are going for a 30 days moving average, what you will have to do? Again simple, 2 divided by 30 plus 1, 31. So herein you'll be getting a value of 0.06 something something. The exponent for 100 days moving average would be 2 divided by 101, and that will come out 0.019 something, and so on. So that's how it actually goes on. So this way you'll be able to extract the best kind of possibilities and calculation for exponent in a very simple and an easy manner. So don't go for any other big short method. It's a very simple one. Do take it, and definitely you'll be able to score the full out of full marks for if in case question arises in your examination. So once we got the exponent, we need yesterday's exponential moving average. So that's the only thing which will be required. So remember, the first data, or I'll say the first EMA, first exponential moving average, or yesterday's exponential moving average is nothing but simple moving average of that many number of days. Remember guys, for example, for calculating 30 days EMA, we would simply need the first EMA, which is nothing but 30 days SMA, that is simple moving average. The second piece of information we need is today's closing price. Remember, I just talked about it in my last slide. So remember, that has to be remembered by you, that the first EMA or yesterday's exponential moving average is simple, nothing but simply the simple moving average of that many number of days. After obtaining the previous day's exponential moving average and current day's closing price, we can use the formula to calculate today's EMA, and which was this: current day's closing price into exponent plus previous day's EMA into 1 minus exponent, and thereby you'll be able to get the calculation of EMA as well. So guys, this was all about exponential moving average. I hope you guys got the complete clarity as to what does simple average moving average mean and exponential moving average mean. Next topic, and that will be about triangular and variable moving average. Remember guys, I told you about 5 moving averages: simple, exponential, weighted. Weighted is being used in simple as well as exponential, and the other two was triangular and variable. So what does triangular moving average means? Basically, a triangular moving average gives more weight to the middle part of the price series and involves taking the simple moving average of a simple moving average. So that's how it goes for. And this double smoothing basically eliminates the noise even further. So that's how it goes on. A triangular moving average gives more weight to the middle part of the price. That's how triangular is being made. So if you will be giving more of the emphasis and more weight to the middle part, let's suppose Ishan Sharma is bowling at a rate of like 140 km per hour in the first delivery, and in the 6th delivery he goes for 145 km per hour. And if I'll have to like get the best kind of result, what I'll do, I'll simply get its middle ball pace, that is like 143 km per hour, and I'll simply multiply it by like 4 weight, and for the rest of the weight I'll simply go for 1. So if in case, that will help me in getting the best kind of result for that average one. So thereby this triangular moving average gives more weight to the middle part of the price series, and it actually involves taking the simple moving average of a simple moving average, and that's how this double smoothing basically helps in eliminating the noise even further. So that's basically about triangular moving average. And now let's understand what does this variable moving average means. A variable moving average is an exponential average that factors in the security's price volatility. The more volatile the price is, the more the average are smoothed, and the more weight is being given to the current data in this one. So that's how this variable moving average flows in. So guys, that was all about moving averages. We did discuss about simple moving average, exponential moving average, weighted one is being used in all 4, triangular moving average and variable moving average. So I'll be concluding my video with this particular segment, and I'm sure that you guys did got the complete clarity as to how moving averages are being ensured and flowed through. Moving averages are the ones which are actually going to help you in understanding your charts as well as your Bollinger Bands. I'll be discussing about Bollinger Bands in my next video presentation, wherein you'll be able to get the idea how you can use another kind of tool for extracting the best kind of returns in the securities market. With this, I'll be concluding my video with a dose of motivation, and that will be: the more the man meditates upon good thoughts, the better will be his world and the world at large. This quote was being mentioned by Confucius. So obviously, guys, you'll have to think good in order to achieve something good in life. Okay. You can't achieve something good in life only by thinking something bad about other people, right? So think about good thoughts, think about good actions, think about good work which can be achieved, and good dreams, good aspirations. Only then you'll be able to focus on the better things in your life, and certainly the world will be yours completely in that case. And that world will be whole, full, and complete in its each and every sense. That's how I'll be concluding with this. With a thank you on behalf of the Edupedia world. Keep interacting, guys, via questions, queries, the comment boxes. YouTube is providing you the best kind of facility, and stay connected. That will help us in understanding your needs way better, and certainly that will help us in helping you out in a better manner than we were doing yesterday. Keep enjoying the videos, guys. Certainly that will help us. Perfect. Take care, guys. Love you. Bye.